We're looking at a deep value analysis on supermicrocomputer, SMCI, that makes a pretty bold contrarian call that its 10x forward PE makes it the cheapest AI stock out there.
Yeah, that's really the theme, isn't it? The whole report is built around this massive disconnect.
A huge one. You have 47% year-over-year growth, a forecast for $36 billion by 2026.
And yet the stock gets a 60% haircut. It's trading at a PE that, suggests the company's fundamentally broken.
And the analysis report is pretty clear. It says the reason is margin compression, this fear about the price wars.
Right, the fear that they have to give away all the profit to win these big AI deals.
But the report argues that penalizing them this much is just, well, it's an overreaction, especially when you look at peers like NVIDIA, trading at, 40x? That peer comparison is a good starting point, but I don't think it's enough to win the argument on its own.
I agree. So to really solidify this deep value thesis, the analysis should contextualize that low PE. It needs to specifically prove why SMCI is worth more than 10x, even with those margin pressures.
I see the weakness there. It's like it identifies the problem margin compression, but then it uses a comparison to high-margin chip designers, which is a bit apples and oranges.
Exactly. It doesn't really get into the weeds of how Wall Street actually values a lower-margin hardware business.
So the core argument is kind of vulnerable, because you could almost defend a 10x multiple for a hardware assembler, right? I mean, if you doubt that the growth is sustainable or, high quality.
That's the bear case in a nutshell. The analysis needs to do more. It needs to quantify why the sheer velocity of this growth, that leap to $36 billion, justifies a re-rating on its own, regardless of today's margins.
So it's not just about the growth rate, it's about the value of that growth.
Precisely. And my suggestion here is to bring in other valuation metrics. Go beyond PE.
Like price to sales?
Price to sales, EV to EBITDA, these are perfect for this scenario. They reward market share and scale, even if profits are being reinvested or, temporarily squeezed.
That feels like a much stronger defense. PE can get so skewed in these hypergrowth phases.
It really can. So, for a concrete example, instead of just talking about the PE, calculate the implied price-to-sales multiple on that projected $36 billion in revenue for 2026.
Ah, okay.
Then you can show that even if margins stay tight, that forward PS is just ridiculously low compared to its peers, even slower-growing ones. It proves the valuation gap is real across multiple metrics, not just this one PE number everyone's obsessed with.
And that tackles the skepticism head-on.
One last thing on this point. You could even estimate the free cash flow yield at the current stock price.
And argue that it's being priced like a dying business, not an AI growth engine.
Exactly. It forces you to confront just how absurd the current pricing is.
Okay, let's switch gears to the competitive moat. The report flags the NVIDIA Blackwell ramp-up in 2026 as the huge catalyst.
But then it immediately brings up the price war with Dell.
Yeah, which creates this tension. It says SMCI builds the special racks and the critical liquid cooling for Blackwell.
Which sounds great. It sounds like a moat.
But if they're so critical, why are they in a price war? Why can Dell just come in and undercut them?
This is where the thesis gets really tested. And this is why sharpening the specificity of that competitive advantage is it's non-negotiable.
So the weakness is that racks and liquid cooling is just too generic.
It's way too generic. If it's a commodity that Dell can also make, then that $36 billion revenue target could just be profitless revenue.
Right. The whole re-rating story falls apart.
It does. The moat is just underexplained right now. It feels like we're just supposed to trust that they'll execute better instead of having a real structural reason why they'll win.
So what if we lean into the technical challenge? I mean, Blackwell chips are power hogs. They change everything about data center design.
That's the perfect angle. That's the suggestion. Get specific. Provide the technical details on what SMCI's integrated solution, especially their liquid cooling, proprietary or just flat out better for these new high-powered chips.
It has to be more than just we have liquid cooling. It needs to be our implementation of liquid cooling is superior to what a giant like Dell can do.
Yes, we need that tangible evidence of a lead. So for some concrete examples, the report could focus on things like SMCI's vertical integration, their ability to design and build an entire cluster in-house, super fast.
And how that lowers the total cost of ownership, the TCO, for the big data center clients.
TCO is everything. If you can show a structural TCO advantage, that's way more powerful than winning on price for a quarter.
A much stickier advantage.
Or another angle is to talk about their early certification with NVIDIA. argue that their co-development for Blackwell's power demands gives them a time-to-market advantage that Dell maybe can't close until, I don't know, late 2026?
Which turns the Blackwell ramp from just an industry tailwind into a unique proprietary opportunity for SMCI.
Exactly. It makes that $36 billion target feel so much more defensible.
Okay, let's move to the final section, the technical analysis. The report notes this strong support floor around $28 to $30. Oversold RSI.
But the whole thesis is a long-term hold for 2026.
It's a bit of a jarring shift, isn't it? We go from this multi-year investment case to what feels like signals for a swing trader.
That's the weakness right there. It's a structural disconnect. The language used, support levels, gap fills, it just clashes with the deep value contrarian theme.
So the charts are being used to show how the stock might move, but they could be used to show how the market is feeling, and why that feeling is totally wrong.
Precisely. That's the suggestion for improvement. Reframe the technicals. Use them as graphical evidence of irrational, emotional capitulation in the market.
Oh, I like that. The chart isn't a trading map, it's proof of investor hysteria.
It's proof. It's where your fundamental value proposition, that 10x PE, meets maximum panic.
So how do you do that practically?
Well, for a concrete example, you don't just call $30 a support floor. You position it as the line of fundamental sanity.
Okay.
You argue that any move below that, or any deep push into oversold territory, is the market literally pricing the company for failure, which makes it the highest risk-adjusted entry point for a contrarian.
And that ties the technical entry right back to the valuation disconnect we talked about at the start. It makes it one unified story.
And you do the same for the upside. That resistance at, say, $38, that isn't just a target.
It's a trigger.
It's the technical confirmation that the market is finally starting to price in the good news, that they're starting to believe in margin stabilization or the Blackwell story. It links everything together.
This is really strong stuff. I mean, the analysis report has the bones of a really powerful contrarian case.
It absolutely does. It's an exciting idea.